Wedgewood Partners' latest letter to clients, and it's packed with insights that could shape your investment strategy for 2025. I'm particularly excited to share this because Wedgewood has an impressive track record consistently outperforming major indexes over multiple decades. Let's start with their performance. Wedgewood's composite returned 29.1% in 2024, beating the S&P 500's 25% return. But here's what's really interesting. Over the past 30 years, they've delivered a remarkable 30.2% annual return compared to the S&P 500, 10.9%. For those keeping score, that's an extra 2.3% per year for 3 decades, the kind of outperformance that compounds into serious wealth. 2024 was basically 2023's twin brother. The S&P 500 gained 25% following 2023's 26% gain, creating a stunning 2 years return of 58%. The best 2-year gain since 1997-1998. But here's the kicker. The equal-weighted S&P 500 was up just 13% in 2024 and only 28% over these 2 years. This massive disparity shows how concentrated these gains were in just a handful of stocks. Let's talk about some fascinating portfolio moves. They sold Texas Pacific Land, a company that owns over 800,000 surface acres in the Texas Permian Basin, most acquired in 1888. Why sell such a unique asset? Because the stock was added to 2 major indexes and its value tripled in just 7 months, without any real change in earnings power. This is what they call pure animal spirits at work. Their approach to AI is particularly interesting. Over the past decade, Meta has spent around $160 billion in R&D and $130 billion in capex, while generating cumulative gross cash flows of $280 billion. Alphabet has spent even more, $250 billion on R&D and $200 billion in capital expenditures, generating almost $500 billion in gross cumulative cash flow. Both companies have been using machine learning and AI-like technologies long before it became trendy. Now let's dig into why they're worried about 2025. Here are some eye-opening statistics. The current NVIDIA situation is particularly concerning. Its market cap is almost 12% of US GDP, more than double what Cisco was at the peak of the dot-com bubble at 5.5% of GDP. Even more alarming, the single stock ETF offering 2x exposure to NVIDIA started 2024 with $220 million in assets and ended with $5.4 billion, a 24x increase. The debt situation is equally worrying. The United States now holds a record $36.2 trillion of national debt, with some stunning figures. Since 2020, total US debt has increased by $10 trillion. In 2024 alone, debt increased by $2.2 trillion. Annual interest expenses has hit $1 trillion, up from $450 billion just 2 years ago. The government needs to refinance $7 trillion in 2025, likely at higher rates. The manufacturing sector is showing concerning signs. The ISM manufacturing PMI has been below 50, indicating contraction for 25 out of the last 26 months, something that's never happening before. In data going back to 1948, their 3 largest holdings tell an interesting story about valuations. Alphabet trades at 21x forward earnings, Meta Platforms at 24x forward earnings, TSM, Taiwan Semiconductor, at 23x forward earnings. These look relatively reasonable compared to some other tech giants, suggesting there's still value to be found if you know where to look. A particularly telling quote about their current stance: "The positive fundamentals underlying the gains in the stock market in 2024 may portend net bullish tides in 2025. That said, here are a few of our favorite worrying things. The bond market relationship is crucial. The bond market and stock market are hip tight at correlations rarely experienced over the past half century. As such, the bond market tail may considerably lag the stock market dog in 2025. They're especially concerned about leverage trading. There are now 100 times more assets in leveraged long funds than leveraged short funds. Over just 8 weeks, this ratio doubled, exceeding the record high set in December 2021. Do you remember? Looking at household investment patterns, there is another warning sign. Households now hold historically outsized weighting in stocks. If bond yields continue their ascent, bonds will become quite attractive competition to future stock returns. Remember their powerful conclusion. At Wedgewood, we've curbed our enthusiasms. We expect greater stock market volatility in 2025 than witnessed last year. Accordingly, we're patiently waiting for better prices for both new positions as well as adding to existing positions. So seems like they do the sin of market timing that I always try to avoid. But if they can, why not? The key takeaway: sometimes the best investment move is patience, especially when everyone else seems to be peeling into the market. As they noted about their Texas Pacific land sale, when indexes are tripling their appraisal of a company's value while that value hasn't changed, it might be time to step aside and wait for better opportunities. Stay smart, stay patient, and remember, when everyone's in the pool, maybe it's time to check the water quality before diving in. And you can see my results as a portfolio manager here. Thank you for watching, and please press like. That's how I know that I should continue this hedge fund letters reading, and I'm useful for your investments and analysis also. So thank you one more time and see you.